a logistics firm in Lagos, is running out of options. The naira has fallen again. Margins are tightening, suppliers are demanding payment, and staff salaries are due by morning. But instead of walking into a bank or calling a currency broker, the company does something different. It pays in digital dollars. No correspondent banks. No paperwork. No FX restrictions. In under 5 minutes, payments are settled on the blockchain using USDC, stablecoins pegged to the US dollar. No delays, no volatility. What started as a temporary survival tactic quietly becomes standard business practice. By the end of the quarter, the entire payroll has shifted to stablecoins. Not because it's trendy, but because in a country where your currency can lose 10% of its value in a week, stability isn't a luxury, it's strategy. And this isn't just the story of one company. It's the first chapter in a financial shift, reshaping how people store value, move capital, and conduct trade across Africa. This transformation didn't appear out of thin air. For decades, African markets have been defined by currency devaluation, inflationary pressure, capital controls, expensive remittance channels, and underdeveloped banking systems. Sending money across borders could take days. Fees for remittances could reach 15%. Local savings were eroded by inflation faster than wages could keep up. Bitcoin offered an escape, but its volatility made it unusable for salaries, trade, or working capital. And then came stablecoins, digital assets designed to mirror the value of stable currencies like the US dollar or commodities like gold. They moved like crypto but held value like cash. Around 2020, traders and freelancers began to use them quietly, bypassing traditional banks and FX markets. By 2023, they were no longer an experiment. They were financial lifelines. Today, billions of dollars flow through stablecoins every year in Nigeria alone. What began as a hedge against inflation has evolved into an alternative settlement system. From Ghana to Kenya, Zambia to Ethiopia, and Uganda to South Africa, stablecoins are powering e-commerce, remittances, cross-border logistics, import financing, and even agricultural payments. More than 70% of African stablecoin users rely on them for savings or remittances. Others use them to pay school fees, insure crops, settle trade invoices, or pay remote workers abroad. In Kenya and South Africa, stablecoins have already overtaken Bitcoin in everyday transactions, not for speculation, but for utility. Globally, this shift mirrors a larger financial trend. Stablecoins have grown from a $5 billion market in early 2020 to more than $230 billion by May 2025. But in Africa, they took a different path, not as speculative crypto assets, but as a parallel financial infrastructure. Soon, regulators had to respond. In 2025, Nigeria became the first African country to formally classify stablecoins as regulated securities. Shortly after, the African Stablecoin Consortium launched the CNGN, Africa's first regulated stablecoin backed by commercial banks and fintech institutions. Across the continent, economists, central banks, and policymakers began to ask, should Africa continue depending on dollar-backed stablecoins? Or should it create local currency versions to protect monetary sovereignty? But with innovation came risk. If millions of people begin holding digital dollars instead of local currency, central banks lose control of monetary policy. Tax authorities struggle to trace value flows. Capital exits become harder to manage. And one poorly collateralized stablecoin could trigger a liquidity crisis. Yet, despite these concerns, stablecoins are already woven into Africa's financial bloodstream. They serve as informal savings accounts in countries with unstable banks. They move money where SWIFT cannot. They allow small businesses to trade beyond borders. And they offer households a shield against inflation. Where does this lead? With smart regulation, transparency, and collaboration between fintechs, central banks, and capital markets, stablecoins could become the backbone of Africa's next financial system, enabling faster trade, lower transaction costs, and even tokenized government bonds and commodities. But without balance between innovation and control, they could just as easily weaken national currencies, deepen dollar dependence, and erode monetary sovereignty. The question is no longer whether stablecoins will shape Africa's financial future. They already are. The real question is, who will control it? And will this new system strengthen Africa's financial institutions or quietly replace them? For more intelligence on Africa's economy, finance, and capital markets, follow us at Spotlight in Africa.